2026 Operators Retrospective. This piece captures the moment millennials took over the market. But what stands out now is the technological dissonance. Ever since my 2006 Spekinex days, something felt clunky about the process. In the following decade, the ubiquity of high-speed internet and connected devices finally allowed shoppers to browse and enter the new home process digitally. Concurrently, the slow buildup and pop of the iBuyers pre- and post-2020 quietly proved a massive structural point. There was an alternate liquidation channel for existing homes that didn't require the full paid assistance of a 3% buyer's agent. We had the pieces, but the confluence of events wasn't yet primed. It took the current AI revolution to finally provide the interface to execute the newer way. May 2026. Grasping the mechanics of the housing market is critical for operators, investors, and consumers. This analysis evaluates the primary trends dictating the trajectory of the U.S. housing market in 2020. Economic expansion and income growth. Housing demand is fundamentally tied to affordability and disposable income. While the IMF, World Bank, and Federal Reserve project U.S. economic growth to slow relative to the past 2 years, consensus indicates a recession is unlikely in the near term. Real GDP growth is expected to sustain at roughly 2% through 2022. Concurrently, U.S. personal income has risen consistently for 6 years. When coupled with an ultra-low unemployment rate of 3.6%, consumer confidence is at its highest sustained level since the 2008 financial crisis, driving baseline housing demand. The rate environment. Mortgage rates are the ultimate lever for buyer velocity. Following global economic headwinds in early 2019, the Fed cut rates 3 times, aggressively lowering the cost of capital after a series of 4 rate hikes in 2018. At the December FOMC meeting, the Fed chair signaled that interest rates would remain steady through 2020. This environment, low baseline rates combined with steady economic expansion, acts as a direct tailwind for mortgage originations and new home demand. Price appreciation and the supply constraint. The S&P Case-Shiller U.S. National Home Price Index sits at an all-time high. While this rapid appreciation raises concerns of a recurring housing bubble, the fundamental mechanics differ vastly from 2005. Strong market basics, low unemployment, tight lending standards, and controlled interest rates support current valuations. The true driver of this price escalation is a structural lack of supply. Existing home sales dropped sharply in 2018 and failed to fully recover in 2019. Demand remains high, but buyers are physically unable to locate inventory that meets their affordability constraints. This persistent supply-demand imbalance guarantees continued upward pressure on pricing throughout 2020. The millennial driver. Demographically, millennials will dictate housing market growth for the next decade. Recent data indicates this cohort possesses peak savings rates and is executing larger down payments. Because this buyer pool is entirely tech-native, the industry must prepare for a massive shift in capital allocation toward digital marketing and online acquisition channels.